Mr. Meyer had just bought a new home for his family. The future looked bright, until one day in 2008, the financial crisis arrived. Switzerland's major bank UBS was threatened with bankruptcy, and Mr. Meyer, along with many other Swiss, was suddenly faced with losing his job. With UBS serving almost 1 in 2 Swiss companies, small businesses were threatened to collapse, putting people out of work. Not to mention the more than 26,000 people working for UBS in Switzerland. Account holders were suddenly faced with losing all their savings, so the government had to intervene. Together with the Swiss National Bank, they created the Stability Fund, a bad bank, which would absorb all the toxic assets that threatened to bring down UBS. These assets were mainly loans people had defaulted on, and were therefore rapidly losing value. The National Bank covered the lion's share of potential losses with a loan to the Stab Fund. A smaller amount was paid by UBS, which it had to borrow from the government. This was a lot of taxpayers' money that was put at risk, but it saved UBS from going bust. And Mr. Meyer and many other Swiss could keep their jobs and their money. And what became of the bad bank? It turned good. As the markets recovered, the toxic assets regained value and could be sold off. This, along with the interest on its loan, generated quite a bit of profit for the Swiss National Bank. And also the government made some profit from the interest on its loan to UBS, which made the taxpayer happy. But the question remains, is UBS and its rival Credit Suisse still too big for Switzerland's good?